So, Sebastian, you recently wrote this book, The Psychology of Leadership, and have talked a lot about what investors can learn from sports psychology. And it seems like right now, this group of stocks in the market kind of has a hot hand. How do you navigate that?
I think sports psychology is greatly underrated in general for self-improvement, but in particular for investing. Because if you think about athletes, they have to deal with a lot of uncertainty. They can prepare as much as they can, but they can face bad weather, a ref that's not fair. They can't control what their opponents are going to get. So those that are process-oriented in sports psychology, it's demonstrated that they're able to differentiate between luck and skill. And we're just talking about speculation. When there's a lot of speculation, investors forget to differentiate between luck and skill. I can make a really bad decision. I could go out to dinner and drink too much wine and drive. And if I get home safely, it's a good outcome, but it was a horrible decision. Or if I use Uber, but Uber gets in a crash, it's a bad outcome, but it was a very good decision. So the mindset of separating outcomes from the quality of the decisions you make is really difficult, but really important for investors. That's why I'm glad you asked the question, Gunjan, because probably maybe in our audience now, there's a lot of people making a lot of money right now in markets. But think about whether it's luck or skill.
Given all of this speculation right now, how are you positioning?
So we are, in a nutshell, neutral between stocks and bonds because I talked about signs that we might be in the run-up to a bubble, but I also talked about very strong fundamentals, stronger than most people think. So we like to sit at neutral. We're long diversification. So the portfolio is less concentrated. For example, we have an overweight position to international value and small caps. And we are short duration, meaning we have less interest rate sensitivity. We have less treasuries, long treasuries in the portfolio than we would normally have. Neutral stocks and bonds, long diversification, for example, international, and short duration. We have a view, and it's not just tariffs, that there are upside risks to inflation, whether it's the pace at which wages are growing, a housing shortage in the country, the risk that commodities could pop anytime. Add to that tariffs, there are some upside risks. Add to that deficits, which can put upward pressure on the 10-year, and you get the picture for why we're underweight duration. We have more cash in our bond portfolio than long bonds, and we also have more credit than long treasury bonds.